Joining us now, Paul Ciana, Head of Technicals Research at BofA Securities. Paul, great to have you with us.
Likewise, thanks for having me on. It's good to be here.
So the big question is what direction do you see yields going in? Because, the last time the Fed cut, when they cut 50 basis points, yields didn't go lower. They did the opposite. And so I think the question here is we are sort of seen as on the verge potentially of a cut. Where do yields go?
Sure. So more often than not, as a technical strategist, all that stuff kind of sits on the side, and we leverage our process of the patterns and the signals within the charts to dictate where we think they're going. And over the course of the last year, they've actually been trading in a narrowing range, which means they're essentially trendless. And even at this point, they're trading at a level that they've been sitting at for the last few sessions. They've just been swinging higher and lower consistently in the same direction, right? So our view is more predicated on the fact that we're in a converging range, right? And that range is getting narrower. And there's tactical downside risk for yield through the end of the month, maybe through Labor Day, as the 50-day moving average just crossed below the 200-day moving average. And the move after non-farm payrolls on August 2nd caused a technical breakdown that suggests we're going to the lower end of the range first.
So the 50 crossing the 200, that's known as a death cross, which never sounds good. But when you're talking about heading to the bottom of that tighter range, what is that bottom?
Sure. The bottom of that range is about 4.05 to 4.1%. So by month end, we could be testing the bottom of that range. And then in the technical process, we have to assess whether or not yields are breaking further to the downside, or if they start basing there and swing higher back up to, say, 4.4% in September. And that's the tactical nature of these short-term markets that we're in and these ranges that we're stuck in.
Even if you think about 405 versus, to 440, that's a very tight range. And that is lower than the current range that a lot of people are looking at for the 10-year yield, Paul. And so I'm wondering what you see for stocks with yields that low, potentially.
Yeah, it's interesting that you talked about the death cross with the 50-day crossing below the 200-day on U.S. 10-year yields, because one of the things we did in our report this morning was highlight what that signal actually means for other asset classes. And what I find interesting is, while that signal suggests yield is lower, roughly 45 to 55 trading days later, it actually suggests the S&P 500 is up in that 45 to 55 trading day window. In fact, up more often than not. So it could be that if yields move lower, it allows the tech sector to outperform and continue to boost the S&P. And we have an S&P 500 target this summer of at least 6,500 and upwards of 6,625. I was speaking with Mr. Santoli a few weeks ago about that. And, we're getting there. So maybe that's what we need is a lower yield environment to allow equities to do their final thrust up to that target.